To me, this is that stage three massive topping phase where we could go into a bigger sell-off and go into a stage four, a financial reset that could be a 50+% crash in some of these indices.
Are you a permabear, Chris?
Yeah, well, you know what? I guess I'm guilty for it. In fact, I've written a few very interesting articles here, and this one over here, I think people need to read. If you think I'm a perma bear, and I drive you nuts with my bearish topping claims, yet I'm always long the markets, which I know gets under people's skin.
Stock markets are somewhat calm after last week's Jackson Hole meeting. We'll be dissecting what's going on in the markets and what's next with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Welcome back, Chris. Hope you've had a good weekend. Like I mentioned in the beginning, stocks are somewhat flat this morning. The S&P is flat. The NASDAQ is flat. Gold's down slightly at $3,400 an ounce. Bitcoin is the biggest mover on my screen right now, down 2.4%. We'll talk about that. The dollar's holding steady, and treasury yields are holding steady as well, up 0.45% on the 30-year. Crude oil is spiking 1%. We can talk about that. Big moves in crude oil. So welcome back to the show, Chris. Good to see you.
Hey, thanks for having me, David. Always a pleasure.
Yeah, let's start with the biggest movers, though. Bitcoin. So it's interesting because, like I said, stocks are kind of flat today, and Bitcoin is just taking a huge beating. I mean, it's not huge for Bitcoin. You know, we've seen 10, 20% moves in a matter of days before. So 2.4% is really just a run-of-the-mill Monday for Bitcoin, but it is remarkable and notable given that stocks are flat and Bitcoin typically has followed stocks. So I'll let you comment on that.
Sure. Well, if we take a look at the chart of Bitcoin, obviously it's not pushing near all-time highs. It's lost its shimmer. We recently had a play. We actually got out of Bitcoin, locked in some profits right near the peak when it hit a first target, and it's not finding the love. I think all the love is going to Ethereum, where I think there's lots of big wigs in the I think the crypto space have kind of shifted their focus over to Ethereum. And so I think it's really pulled people over. But Bitcoin really struggling. It was looking primed and ready for a big move. It really hit this first little level of resistance and it's just been rejected. So, I mean, at this point, Bitcoin's lost that media driven move. It's always had that for forever, it seems. And the fact that it's going the opposite way, to me, is a warning sign that maybe this shining star in a lot of people's eyes isn't actually going to perform as they want. And people are rotating to a different crypto at this point.
So you think that maybe right now is a time that the alt season is starting to kick in, where we have Bitcoin dominance falling? Actually, if you'll take a look at the Bitcoin dominance chart, if you allow me to share my screen for just a second here, this shows the Bitcoin market cap as a percentage of the total crypto market cap, and that's been declining ever since late June. Peaked at 66%, and now it's down to 58%. So it really looks like you said, some of the other cryptos are taking the spotlight here.
Yeah, and what's interesting too is the Nasdaq. When we look at the Nasdaq, because Bitcoin has followed the Nasdaq quite a bit. Well, the Magnificent Seven and the Nasdaq pulled back quite a bit going into the Jackson Hole meeting. People were getting nervous, lightening their load, and the Nasdaq isn't near all-time highs. In fact, we're seeing the S&P 500, we're seeing mid caps, small caps, micro caps, dividend stocks all popping and moving higher. And so people aren't interested in Bitcoin and the Magnificent Seven after really in the past couple of weeks, to be honest. And we're seeing money move into the broad market. And that is a good sign for the stock market. We want to see a broad market rally. We don't want to just see one pocket of stocks, a handful of stocks drive things up. We want to see people moving in all over the place. So I think maybe people got their fix of the Magnificent Seven temporarily and maybe of Bitcoin, and they're starting to look elsewhere. So that's kind of we're in this kind of shift. And you and I talked 2 weeks ago. I said, this is a really critical turning point. The market, I think, is changing its dynamic. And the big question here is the market going to consolidate, pause here, and then break higher and run up? Or is it going to stall out and then reverse and sell off and kind of do what we saw back in 2024? And I shared this chart with you and everyone last time you and I spoke a couple of weeks ago, saying, hey, we're in this turning phase, potential turning phase. The big question is, do we do what happened last year and test the April lows, or are we going to, break out and go higher? At this point, the market is still looking like it wants to go higher, and we're seeing broad market strength, which is a good sign of that.
Okay. Do you think Bitcoin can serve as a leading indicator from this point on for the broad markets?
No, I've never used it as a leading indicator. No, no, I don't.
Okay. No, just no. Well, let's take a look at the breadth of the stock market now. Not much activity today, but if we take a look at some multi-day or multi-week trends, I wonder if it's forming a topping pattern. Let's see.
Yeah, I mean, if we look at the daily chart, I mean, it's in a strong uptrend. It's kind of just trying to figure out like the S&P 500 here, trying to figure out if it's going to break higher. If we look at the weekly chart, take a bigger look, you can see here it's in a nice strong uptrend as well. I mean, it just had a pause about a month ago, a pullback, and it's recovered. So it still has a very strong chart even on the weekly. And if we go to the monthly chart, you can see here, I mean, it's still a green bar. It's above this 5-period moving average, this light blue line. And when you can hold above this light blue line, you're in a very strong phase. It's a high momentum move. So we're still in this high momentum move, and it really, we've got to wait for this to run out of steam. And we're from an economic standpoint, I do think the markets are getting a little, they continue to kind of weaken. We've seen, people going from job hopping, like they get a job and if they don't like it, they just jump to the next one. And people couldn't, businesses, entrepreneurs couldn't find quality staff. And now it's gone from job hopping to job hugging is like the new term I just learned about. People just don't want to let go of their job. They're worried. I know a lot of people who can't get a job right now. They just got out of university last year and they can't even get a job at like a fast food place. Like it's crazy how the dynamics have changed. And all this stuff changes slowly behind the scenes before it catches up to the stock market, I think, in a lot of cases. And the market is still moving higher with the Magnificent Seven. It really still is. It's doing a lot of the heavy lifting. Just the last day from Jackson Hole was a broad market pop. And we need to see if it's more than just a one-day thing or if this is a new trend of money flowing into the broad market. So I'm all of the charts for the stock market are still pointing up. When we look at our investing trend, we can identify when the market is, in a bullish environment. 2022 is a bearish environment. We just had a nice bullish environment, and the market had a reset this year from the tariff. And now we're back into a bullish environment. So you don't want to fight the trend. I know the big problem here is a lot of people have FOMO. They missed out on the rally. They didn't take part of it. They're too scared. They feel like the market is going to fall and collapse, which I think it will at any point. But you can't let the fear and the emotions get in front of your trades. You have to still take those positions and go with the trend because the market will continue longer than then you're going to want it to go, and it'll apply maximum pain until it sucks you in. And I do think we're starting to see this market suck in a lot of investors, but we're not quite at a top yet. But I do think it's coming. I think it'll happen this year. We have to let that unfold. And from multiple chart timeframes, as you said, David, from my perspective, everything's still bullish here.
Before we continue, I want to thank Private Internet Access for sponsoring this video. Using the internet without protection is like mailing a letter without an envelope. Anyone can see what you're sending. A VPN solves that problem. Private Internet Access, or PIA, is a VPN that encrypts your internet connection and hides your IP address. That means your browsing activity, personal data, and location stay private, especially on public Wi-Fi, like at airports or coffee shops, where your information is most vulnerable. PIA also gives you access to content that's restricted based on location, so now I can watch my favorite shows from anywhere in the world, and you can switch your virtual location in one click and get around those regional blocks easily. It works across all of my devices. One subscription covers them all and supports unlimited devices. Use my link in the description down below to get an exclusive 83% off. That's around $2 a month plus 4 extra months free. There's a 30-day money-back guarantee, so it's completely risk-free. Go to piavpn.com/DavidLin, link down below, or scan the QR code here to get started. Could it be, Chris, that if the labor market weakens, we could have the Fed lower rates, maybe faster than expected? Certainly, I would be betting on more Fed easing, which may be good for markets. So we may be in a period where bad news, at least for the broad economy, may be good news for the markets. Powell said last week, risks to inflation are tilted to the upside and risks to employment are to the downside. A challenging situation. So something similar to what you mentioned. The Fed will proceed carefully, but he said the shifting balance of risks may warrant adjusting our policy stance. So markets are now pricing in a likely chance of a cut by September.
Yeah. I
So I
mean,
wonder how. Yeah, no, go ahead.
yeah, I mean, they just tweak the odd word here and there and throw in a new little phrase. I mean, I think people read into it way too much. They're always balancing on, they're always saying they're going to make adjustments if needed. Who cares how they say it? It's the same thing. I just don't read into those statements and all that stuff
Hmm.
too deeply because they're always weighing everything and they're going to make a change. That's why you really just need to follow price, follow the money flow because you don't know what they're going to do, when they're going to do it. And it really is, just their words are like a spell and they suck people in and they just kind of control their, they have it nailed down. They know exactly how to say to not quite give enough, but there's no direction and you're just always uncertain. So people need to not read into that too much and actually follow the price charts from multiple time frames, as you just said, and that'll keep you on the right side of the market.
Are you still of the view that markets have entered a phase three per your multi-phase outlook, and it's past or just at the tipping point of the euphoria phase?
Yeah, so if we do take a look at that, this is the stage three chart that you're talking about, and I've talked about how I believe we're in this stage three topping phase for a long time. Now, there's this the thing with this where we are in the market environment is we have Magnificent Seven doing a lot of the heavy lifting, pulling the Nasdaq and the S&P 500 to new all-time highs, not representing this kind of topping phase in most stocks. And if we go back and we look at this particular blend of ETFs, now this is the RSP, IWM, and IWC. This is the more or less broad market. It's equal weighted S&P 500. It's small caps and it's micro caps. If we just zoom out, I mean, the grand scheme of things, we'll just go way back here. The stock market isn't breaking new all-time highs. We potentially have a major double top or triple top, however you want to look at it. We haven't really fully broken out with all stocks to new highs. We're pretty darn close, but we're not there yet. And this is usually, every time we've seen the stock market, the overall stock market get to this level, we have seen a 20+% crash and correction. So we need to be very aware that we're at this tipping point where the market could roll over. I shared that chart of 2024, how it shows this is kind of right when it went into a nosedive last year and sold off. If we take a look at the seasonality chart of the S&P 500, usually right at the end of August, the market starts to sell off into October. So there's a lot of headwinds about to run into this market. And while the trend is still up, you need to know it might come to an end soon. If you're in positions, you might have to exit them soon, take a potential loss or start locking in gains. But overall, the broad market to me is in a stage three topping phase. To me, this is that stage three massive topping phase where we could go into a bigger sell-off and go into a stage floor, a financial reset that could be a 50+% crash in some of these indices, which kind of leads over to another chart. I'm not sure you and I have ever really shared before. If we come down here to the economic and business cycle. Now, I usually show the stock market cycles, but this one focuses on this yellow cycle, which is the business, the economic cycle. And what's interesting, the cycle in the background, the blue one is the stock market. We're right here near this major top in the stock market. This is where innovation and adaptation, eagerness really comes into play. And because the innovation right now, it happens to be in tech, in large tech that drag the indices up, it's camouflaged this stage three topping phase. So yes, the indices are going up, but it is still really a handful of stocks doing most of it. And that's because we have AI. That's because everybody's adapting and bringing it in, and it's spurring all kinds of work and innovation and costs and sales. And it's keeping I think the economy really purring here and holding its ground. But once this phase fizzles out and people realize, okay, well, yeah, AI is great, but it still has a lot to come, to unfold before it really becomes really useful, then I think the markets will roll over. So we're in this phase where people feel the innovation and they're applying it, and it's just another one of those signals that we're got to be aware that usually when the music's good and everybody's having a good time and you're at the top, there's usually only one place to go, which is down from there. And so we're in this. I believe we're slowly maturing through this stage three topping phase through this economic cycle, and we're already seeing it with ChatGPT. I mean, Sam Altman really threw a curveball with anybody using ChatGPT. He forced ChatGPT 5 on everybody. It's not the best. It has all kinds of issues. Everybody complained right away. And within a day, they brought ChatGPT 4.0 back. They're cutting costs. Supposedly that new system long story short, AI is realizing they need to stop bleeding money and they need to start focusing on efficiency and slow down a bit. So that's where I believe we are in this kind of economic and this business cycle. And once it does start to slow down, we might actually see the economy slow down, jobs potentially jobless claims start to go up.
I think it's because you've been saying that we've been in a topping phase, phase three topping phase for quite some time, that people have been calling you a perma bear, at least on my
Yeah.
channel. Can you address that? Are you a perma bear, Chris?
Yeah, well, you know what? I guess I'm guilty for it. In fact, I've written a few very interesting articles here, and this one over here, I think people need to read. If you think I'm a perma bear, and I drive you nuts with my bearish topping claims, yet I'm always long the markets, which I know gets under people's skin. They need to obviously follow me to get the full gist of it. But I wrote this article about me walking in as a perma bear into a bull market and how I'm guilty for it. But what it really means is it's actually one of the best compliments I could get, but people just see it the wrong way and they don't understand how I go about managing that. And all these articles here are very, very educational, and they help you see how the markets function, and they carry over into position management, risk management. And being a bear, people who are a perma bull, you've got like I just wrote an article about Kathy Woods to Tom Lee. Kathy Woods was the hero. She was the perma bull, had everybody into the markets until that strategy didn't work, and there was no exit plan. Everybody holding the ARK ETFs lost 75+%. Tom Lee is the new superhero. He's everywhere. He's super bullish, always has good upper forecasts. And this article talks about how that journey starts and ends with all of these different people that come through as mainstream media. And so, anyways, if people want to hear about my perma bear view and what it actually means, it means I'm always looking out for our portfolio. I'm always focused on protection versus being totally blind to protection and just saying, "Oh, it's going higher, buy, buy, buy," which is what everyone else does until the music stops. And then their strategy, most people realize it wasn't a strategy. It was them getting sucked into the markets, getting money under management. That's what these big institutions on Wall Street do, and moving people into their products. But yeah. So, anyways, that's kind of my take on that.
But how can you be bearish in the medium term and still be long? Let's just clarify that. Are you long right now? Because last time we talked a couple of weeks ago, you were all in cash.
We have, yeah, as if people go back and check the chart, you can see the trend had gone neutral. We moved to cash. We moved back into the market. We actually took a Bitcoin trade with one of our strategies. We hit our target, moved out of it. We already locked in gains in our silver miner SILJ trade. We locked in gains on our communications ETF trade, and we're long the indices here. We move in and out. And just because I think the sky is falling and I say, listen, the things are going to get ugly at some point, doesn't mean that's where I trade. I'm just saying have an exit plan, because when it does happen, it's going to happen fast. And every pause and pullback in the market could be the start of it. No one knows where the markets are going. All we can do is say, okay, well, I always just say, well, here's the worst case scenario. Let's just be protected for it. And if the market keeps going up, we'll just ride it higher. I hate giving out high upward targets. It just sucks people in. I just see things differently. I'm very risk oriented. I've been through a bankruptcy. I've blown up multiple trading accounts about 15, 20 years ago. I've gone through all that. And I know sucking investors in with bullish claims is what everyone else does. And what I want to focus on is like, let's just know there's going to be a storm coming. And it's either you're going to lose your shirt and downgrade your lifestyle in retirement, not be able to retire potentially. Let's just have a game plan. And let's always know that storm is brewing, and you never know when that front is going to hit. And until then, we'll just continue to ride the markets up using technical analysis, risk and position management. And when the storm hits, eventually one of those pullbacks will be the one where we go, wow, we totally dodged that bullet. And we just happen to be continuing to grow our money in a different asset class as the stock market falls. So people always want a fixed set. They want to know where something's going from here to there. They want to know the numbers. They want exact stuff. The markets don't work that way. Everybody who does that, it's just not true, because nobody knows for sure. We can say, I think it's going here. This is where price should go. I mean, I always talk like a lawyer. Everything is should, could, would, hopefully, because that's the reality of it. But everybody sticks to anyone in the media who gives like really crisp, clear values. This is going to here, right? Like in the next week, or people want that, but it's actually the wrong way to look at the markets, and you're going to get stuck in some really bad positions. And People like certainty, but there is no certainty in the markets. And I was on a talk the other day and somebody said, Chris, you are certain about this move. And I'm like, I'm not certain about anything. All I'm certain about is we need to protect our money and follow the trends. Like that is the reality of it. But people don't want that, right? They want to say, tell me what to buy, tell me where it's going, and they expect it to work. And if it doesn't, they just get angry. But I just focus on people who want to be protective of their capital, of their life savings, and their retirement. And I don't, I'm not shooting out high numbers and trying to suck people into trades. I'm trying to protect people and move them in and out of the market comfortably, casually, to pull money out consistently and compound our money. We don't have a lot of big gains every year and like big trades where we have huge gains, but that's because we take smaller positions that have our we have a lot of smaller trades, David, that make 1, 2, 3% on our portfolio each time. We have 5 to 12 of these every year, but we compound our growth on every trade. So instead of having a huge winner, we have like 5 or 12 smaller trades that compound on top of each other. And Albert Einstein says one of the most powerful forces in the universe is compound interest. And that's what we do. We take a handful of small, safe trades with our entire portfolio, and we just compound it over and over again throughout the year. And we don't care where the market goes. We don't try and pick a top or bottom. We just are happy with chipping away, and we end up making higher growth returns than most other strategies anyway, because of this, because of the compounding, and because of our high win rate.
You said that people should be aware of this coming brewing storm, and you've learned this lesson before yourself, which is why you're always constantly aware of this in the background. Well, tell us about some of the mistakes that you've made that have made you hyper vigilant. What happened?
Yeah. So, I think one of the big ones was, even when I was a kid, it wasn't even my mistake. It was my parents got involved with a bad investment, and we were living pretty high on the hog. And my dad was retired and got involved in something and didn't realize it was a scam, a shyster who ended up taking all him and his investors' capital. And we went bankrupt. We went from the top of the food chain to the bottom. And that was a real wake up call. And after that, I had also started trading in the stock market. I learned to trade, buy stocks, sell covered calls. I was kind of the only buying stocks that had growth quarter after quarter. I was buying the strongest stocks in the stock market. I took many courses and seminars on how to do this. It was all fundamental, pretty much. And then the tech bubble came, and even the strongest companies in the world with the best growth, their share prices got cut in half, and then they got cut in half again. And I literally blew up my account, and I realized that fundamental and news doesn't do anything. You really need to invest in something going up in price or don't own it. And so that's when I flipped to technical analysis. John Murphy, he's known as like the godfather of technical analysis, big, thick book I've read many times. Learn chart patterns, learn intermarket analysis. That's where I actually shine. I take about 12 different asset classes. We track them all. We have different ratios, and we get an idea of what the sentiment is doing. And I follow not only the price trends, but we want to make sure there's enough sentiment behind it to push that wave. And you and I have talked about this in the past. The stock market, to me, is like the ocean. When the tide goes up, what happens to all boats? Well, when the stock market goes up, what happens to most stocks? They go up. But when we're in a bearish environment and the tide is going down, you don't want to hold stocks. I don't care what sector it is. If you look at pretty much every sector in the stock market during a bear market, they go down. So I move away from assets. I move away from equities in total when we're in a downtrend, period. Whether it's a 2-week downtrend or a multi-year bear market, we don't know what it's going to be, so we move aside. And I've blown up multiple accounts doing this. I used to day trade futures. I blew up a futures account in one trading day. That was the last account I blew up. I funded it. It was a revenge day. I was trying to make back the account I blew up like a month earlier. And so I have lost my money slowly over time from fundamentals and wasted years. And then I have also blown up my money being an aggressive trader in one day. And I've done that a couple of times. So those are all my war wounds, and I've been through it. And now it's like, how can I just grow my entire portfolio and not have to worry about the news or tariffs or the Fed or economic data, and just follow price? We have a lot of subscribers that follow my stuff, and there's one common theme. A couple, they're like, I wish I found you decades ago. I sleep better at night. I don't get as much FOMO and fear anymore because I touch on these like every day in our morning video. I said, You might be feeling fear because we have indicators that will tell us when the mass market is fearful, they're panicking, or when they feel like they're missing out on a trend. So I'm kind of just that voice of reason. I've been told I'm the David Attenborough of the stock market. So like, I just have a very different view and different angle. I'm not out swinging for the fences. I'm just like, how can us savvy investors grow our money in a very comfortable way and never have to worry about risking our shirts and lifestyle?
Okay, well, Chris, the other way to look at it is okay, you've got your strategy, which keeps people safe, sleeping at night, no nightmares. I could just
Mhm.
also sleep at night with no nightmares and no fears and no worries to think about if I just put my money away in the S&P 500 and go away in 20 and 30 years, and my retirement will be fine because historically that's worked out well for people who have done that, right?
And 100%. And a kid could do that. I'm not helping kids. I'm helping people
Mm,
who have money, who are close to
I
retirement,
understand.
who are retired, who don't have 30 years, right? So
Sure.
that's where I'm focused on. So there's obviously every investor has a totally different need and time horizon. I'm focusing on myself where I'm at and everybody where I'm at and ahead of me, so that we don't have to worry about any of that stuff. But the buy and hold works. You hold for 30 years, you should do exceptionally well. But here's the thing with the buy and hold, you will never retire early. You need that 30 or 40 years because you're going to have decade or two in there of no returns where markets are always just recovering from recent highs, all of that stuff. So again, I focus on one particular side of investing for a certain age group. That's my sweet spot.
Okay, let's move on to oil. I want to show an oil chart here.
Sure. Yeah.
Oil
If we
has
take
been sliding down all year, and just today, big rebound. Actually, if you just zoom in a couple days, it's been kind of on the rebound. But I'll let you comment on whether or not this is the start of a trend or just noise.
Yeah, at this point, I think it's noise. I think I actually covered this morning with subscribers that we're in this short-term downtrend. It's been kind of trading sideways. And what I find gold and oil like to do this a lot. They create this, what I call a little hook. So a lot of people will be building a bearish pattern or a position expecting this to go lower. But what happens is you have a little bit of a hook up. Price starts to break some of these recent highs. The shorts start to get nervous. They're on the wrong side. People also start to get bullish and they buy, and it creates a green bar up. And then what it does is it gets the shorts out, spooks them out, gets people long, and then of course it sells off afterwards. We saw something like this several months ago. We sold off. It started to put in a consolidation, and then boom, it has a short squeeze, a little bit of a pop, a hook up, and then it goes back down. And so the markets are really good at doing this. I don't see this being a strong move up at this point. I think it's really just a little bit of a more of a trading play. If we zoom out on the chart and we draw a line across like major resistance through here, price is kind of still stuck under key resistance. And you and I touched on this in our last talk. This big spike up here, I think it was news driven. It goes up for a couple of days. Everybody chases the news. They feel like they're getting left behind, and then it rolls over and takes all their money. Whoever got long chasing it, and so that has to be negated. Just forget about that news driven pop. And oil has fallen right back down into the downtrend under resistance. And it might still want to go a bit higher, but I think it's just a bounce within a downtrend.
What about the other commodities? Let's take a look at gold. Gold has
Sure.
been just consolidating in a range for months now. What's going on with gold?
Yeah, I really like gold. I mean, gold has done many of these where, it has this big rally up and then it consolidates for months and then has a rally, consolidates for months, has a rally. Gold has been warning us for a long time. It's a top performing asset long term. It's near all-time highs. It has a very strong bull chart, a bull flag pattern that points to about $4,100 if this move plays out, maybe even a whole lot higher. But gold is warning us that something is wrong. The fact that it's holding its value and going up long term here is the sign that people around the world are nervous. And I think, gold, sometimes the market, there's a couple sayings. Sometimes the market will, if it can't shake you out, it will wait you out. And that is what it's doing. People are starting, I'm hearing some technical analysts getting really bearish on gold, saying that gold's about to
Hmm.
fall, it's going to have a big drop, which I do think will happen, but not until the economy and everything turn over and we potentially go into a stock market, a bear market. I think that'll pull gold down. But It's funny.
Oh, sorry, a bear market will pull gold down. Doesn't
A
gold
bear
typically
market in
do?
stocks will pull gold down eventually. Just because of the selling pressure, the mass liquidation. And we saw this in 2008
Hmm.
when once the stock market starts to pick up a lot of speed and sells off with huge volume and panic, gold usually gets sold off with it. But before that happens, gold usually shoots up. It'll go higher for a little while, for potentially a month or two, as the stock market starts to sell off. So I'm not really worried
Yes.
about gold. Right now, though, there's no doubt it's gone sideways so long, people are giving up on it. They're starting to go bearish. They're moving into gold miners because they're like, I need to get into something that's moving. This is
Right.
gold. Gold is boring. And silver is starting to move and break out, right? And so people are moving away from gold. That's usually a sign that gold's about ready to actually make a move. So I like gold and silver. And I do think they have potential for 1 to 2 months upward movement. And I think it could be, 20+% for both of them, which would
I
put
want to talk
silver
about.
up near $50 an ounce.
Wait. Sorry. When's that going to happen? This year? Next year?
I would think it's going to happen this year. I mean, I don't know for sure, but the chart pattern is
Right.
based on it should happen. It should start to happen pretty much any week here. It should start to break out and start to run.
I want to talk about silver and finish off on silver in just a minute. But before that, I have two observations on gold I'd like you to comment on. So first of all,
Okay.
on the analysis that people have that this is about to break down to the downside because it's been consolidating for so long. Typically, that's not what happens to gold. If you just take a look at the chart historically and zoom out and take a look at what has happened in the past, whenever gold has stalled for months or maybe even years on end, typically what happens is it breaks out to the upside. A few notable exceptions is 2011. And 2011 was an exception because gold has typically only fallen when it's just spiked up and then
Hmm.
immediately fallen. So then this isn't really a consolidating pattern because in
Yeah.
2011, it's gone up and then immediately fell. And then a multi-year consolidating pattern led to a breakout, as you can see here. In 2022, this is what you were talking about. This is the second observation. In 2022, when stocks go down, that's when, if there's a lot of selling pressure overall in the markets, that could bring the gold down as well. That's what
Yeah.
happened to gold in 2022, went down 20%.
Yeah.
So I'll let
Yeah.
you comment on both of those things.
Yeah. I think you're right. I think right where we are in gold right now, where it's been consolidating. I think it's very close to popping. In fact, if we were to go right over to 2007, gold went sideways for many, many months. And then suddenly, just as the stock market was starting to roll over, gold shot higher and it rocketed up about 37%, something like that. And so this huge pattern is like exactly kind of where we're at right now when we look at gold. It's had this big run up, it's been trading sideways for months. And I think we have one more big push. And I think you're right, David. I think, it is a pause and consolidation at this point. You have to expect it to go higher. To me, I don't see anything bearish about this chart pattern. Um, it really is pointing to higher pricing. It's kind of it in a nutshell.
Okay. Silver, you like silver more or less than gold right now?
Silver's got it has potential to have a decent move. I mean, it could actually pop and rally to, if we were to go all the way back, I think it could go spike up to that $50 mark. I think we could potentially see it pick up speed in the next month or two and shoot up and try and hit all-time highs. I think gold will rally at the same time. Miners, silver is really difficult. You just never know when it's going to have one of these explosive parabolic moves and shoot up. It has a lot of energy built up. It's a small market. A lot of people are watching it, accumulating it. And when it starts to run, it becomes a very crowded trade very quickly, which is what drives it up. At this point, I mean, I see it going to about $41 an ounce, but depending on how this unfolds, I think we could see a much bigger explosion to the upside. And it might have a blow off phase where we go right back into this 50 mark. And this will probably be exactly what you said, David. When gold and silver have that spike up, that's usually also when they come straight back down. So I think this will be that blow off spike move that puts a top in gold and silver temporarily. And then we potentially start to see it sell off.
Okay, Chris. Final question, because we were talking about retirement earlier. When should somebody prep for retirement or start preparing for retirement?
Oh man, I don't know. There's so many different ways to do it. Do you like um
The
I'm
theory
I'm
I've
an
heard
entre
from retirement planners is you should start as early as possible. The moment you get your first paycheck after college, that's when you should be thinking about retirement.
Yeah, 100%. Most people don't. I'm a long-term planner. I mean, I have multiple whole life insurance policy, universal life insurance policies I did a long time ago that are funded, and they are really like lotto tickets later in life. I think if people can get into something like that at an early age when premiums are low and you can put money away every year and it ends up giving you this huge tax-free kind of income surge down the road, I think the sooner somebody could do that, even if you're in your 30s, it's not too late. But time is money for those type of investments. I think people should also look at buying into real estate. I think buying a duplex, triplex, or quad is one of the smartest things you could do at a young age. You can live in one. If the tenant doesn't show up or you miss one for another, it's not like the whole mortgage is on you. Eventually, you'll buy another house and you can rent that out, and you'll have two, three, or four doors paying you 25, 3,500 bucks a month. You'll have cash for life plus an asset going up. There's so many ways to plan for retirement. Young people can get into real estate because it requires tons of leverage. You get a mortgage. Usually, young people don't have big lumps of money to trade with. So that's why real estate, I think, is a very smart play at a younger age. You get a lot more leverage and borrow a lot more money. And but yeah, people should look into it right away. I think if they were to speak with the right financial planner at a young age and see the different options, they'll be like, there's like five avenues or four avenues you can do, and you can do each one a little bit that aren't life changing and require a little bit of discipline. People don't like discipline, unfortunately, and a lot of people don't have any, which is a lot of times why people are stuck where they are financially. Success requires discipline. I don't care what kind of success it is, you have to be disciplined in whatever it is. And the more discipline you have, usually the more successful you are across the board. So yeah, the younger the age, you're never too young to plan long term and know your options and drift towards them at least. Have them in the back of your mind.
Okay, thank you very much, Chris. So stay disciplined and follow Chris in the link down below. We'll put the link to Chris's work down below so you can learn more about his trading strategies and asset revesting, which is a strategy that he employs. We'll see you next time, Chris. Welcome back to the show. Good to see you as always. Take care for now.
Thanks, David. Appreciate it. Take care.
Thank you for watching. Don't forget to like and subscribe.